Know your numbers, why financial statements matter. Understanding financial statements is crucial for anyone involved in business, whether you're an entrepreneur, investor, or just someone interested in the financial health of a company. Listen up, because this is important. Financial statements are the backbone of any business decision-making process. Want to understand a company? You got to look at their financials. These documents provide a transparent view of a company's performance and potential. It's like checking under the hood before you buy a car. You wouldn't buy a car without knowing its condition, right? The same goes for investing in or managing a business. Financial statements tell you how a company's doing, plain and simple. They reveal the company's strengths, weaknesses, and overall financial health. We're talking three main reports: the balance sheet, the income statement, and the cash flow statement. Each of these reports serves a unique purpose and provides different insights. Each one tells a part of the story. The balance sheet shows what the company owns and owes, the income statement reveals profitability, and the cash flow statement tracks the flow of cash in and out. Together, they give you the big picture. By analyzing these documents, you can make informed decisions about investments, management strategies, and future planning. Don't worry, you don't need to be a Wall Street whiz to get it. With a bit of guidance, anyone can learn to read and understand financial statements. We're going to break it down step by step. We'll walk you through each report, explaining the key components and what they mean. By the end, you'll be able to analyze companies like a pro. You'll have the skills to make smarter business decisions and spot opportunities. So, are you ready to make some money? Then let's dive in. Understanding financial statements is your first step towards financial success.
First up, the balance sheet. This is one of the most crucial financial statements for any business. Think of it as a snapshot of what a company owns and owes at a specific moment. It provides a clear picture of the company's financial health. It's all about assets, liabilities, and equity. These three components are the backbone of the balance sheet. Assets are what the company owns, like cash, equipment, and buildings. These are the resources that the company can use to generate revenue. Liabilities are what it owes to others, like loans and bills. These are the company's financial obligations that need to be settled. Equity is what's left over for the owners, like your piece of the pie if you own stock. It's the residual interest in the assets after deducting liabilities. The magic equation? Assets equals liabilities plus equity. It always balances out. This fundamental equation is the cornerstone of double-entry accounting. The balance sheet helps you see how much debt a company has and if it has enough assets to cover its debts. Important stuff. It's a vital tool for investors, creditors, and management to assess the company's financial stability and make informed decisions.
Now, let's talk about the income statement. This one shows how much money a company made and spent over a period of time, like 3 months or a year. It starts with revenue, the money a company brings in from selling its products or services. Then come expenses, the costs of doing business, like salaries and rent. Subtract expenses from revenue and you get the company's net income or profit. That's the bottom line, folks. The income statement helps you see if a company is profitable and if its profits are growing over time.
Section 4. The cash flow statement. Where'd the money go? Last but not least, the cash flow statement. This one tracks the movement of cash, both in and out of a company. Cash is king, remember? It's divided into 3 sections: operating activities, which cover day-to-day business, investing activities, which involve buying and selling assets, and financing activities, which include borrowing and paying back money. The cash flow statement is crucial because it shows you if a company is actually generating cash from its operations. A company can look profitable on paper, but still be struggling with its cash flow.
Section 5. Connecting the dots, ratios, and analysis. Now that you understand the 3 main financial statements, it's time to connect the dots. These statements are the backbone of any financial analysis, but they only tell part of the story. This is where financial ratios come in. They act as tools that help you interpret the raw data from these statements. Ratios help you compare a company's performance over time and against its competitors. They provide a clearer picture of financial health and operational efficiency. There are tons of ratios out there, but we'll focus on a few key ones. These key ratios are essential for making informed decisions.
For example, the debt-to-equity ratio tells you how much debt a company is using to finance its assets. It's a measure of financial leverage. A high ratio could mean high risk. It indicates that the company might be over-leveraged, which can be risky in times of economic downturn. The price-to-earnings, or PE, ratio compares a company's stock price to its earnings per share. This ratio is crucial for evaluating stock valuation. It can give you an idea of whether a stock is overvalued or undervalued. A high PEE ratio might suggest that the stock is overpriced, while a low PEE could indicate a bargain. Don't be afraid to dig into the numbers and ask questions. Understanding these ratios can significantly enhance your financial analysis skills. The more you practice, the better you'll become at analyzing financial statements. Remember, knowledge is power. Keep honing your skills and stay curious.